Very briefly on vision. Vision is very focused, unlike some of the very talented managers here. We're focused on real estate, publicly traded securities, long and short. We seek, where relevant, to be active investors, but not hostile. We've had 14 takeovers of holdings in our funds in the prior 9 years. We're now in our 10th year. And the advantage of what we do is we try to buy real estate more cheaply in the stock market than one can in the property market. And the opposite is true. One cannot short an office building or a dilapidated shopping center. If valuations are excessive or fundamentals are negative, we can be short. We get diversification by property type, by geographic region, and of course, liquidity is a key to what we get for those that own a lot of bricks and mortar, don't have. We launched about 9.5 years ago. We're up 240%, about 14% compounded annually. But more importantly, frankly, to us, when we're highly aligned with significant personal investments, is our focus is on preservation of capital. We don't seek to be the best performing fund in North America. We would love to be the best performing risk-adjusted fund, and a number of factors there, but our pension funds focus on one, and that is the fact we've experienced a negative down market capture ratio over 9 years, inferring that on average, when stock market's been down, we've been up. We believe the best way to make money for investors is don't lose it. In that theme, we think we have a pretty compelling investment idea, and that is GGP. GGP is an S&P 500 company. It's got a $37 billion enterprise value. It owns 100 of the top 500 regional malls in the United States. It has a dividend yield, 4.13%, and I would note the dividend yield went up 10% the second quarter, year over year. And perhaps not surprising to those that read the Wall Street Journal, there's a short interest ratio representing 7.2% of the capitalization. Brookfield Asset Management owns 34% of the company, recently increased that from 29%. And to put this in context, I mean, those that are from the Toronto area, think of Yorkdale. Those with a more broad awareness, think of the Water Tower Place in Chicago, owned by GGP. Think of the Fashion Show Mall in Las Vegas, owned by GGP, across from the Wynn Hotel. The Ala Moana Mall in Hawaii. This is some of the great real estate that is out there. 3 compelling reasons to own GGP. First is, it's all about the real estate. There ain't nothing wrong with the best malls in the United States. In fact, to the contrary, the preferred locations, the compelling demographics, and the dominant presence of these malls preserve and enhance the real estate for the evolution of both retail and other land uses. Stock price, valuation. This stock is cheap, really cheap. Now, both of those are necessary conditions, but they're not sufficient. One could say, my colleague Ira Gluskin said this to me the other day, you could say the same thing about Simon Properties or Macerich. So what is sufficient is multiple catalysts, and we'll get into that in a few minutes, to favorably impact the stock price. Let's talk about the real estate. There's about 7.5 billion square feet of retail across the United States, and there's 23.6 square feet per capita of retail. That's a lot. But only 19% of that is high quality, and there's 3.9 square feet of high quality retail in the United States, and GGP owns 8.2% of all the high quality real estate. What does this mean? These aren't neighborhood shopping centers. These are super regional malls. They're destination malls. These centers, just the ones GGP owns, are within 1 hour's drive of 56% of the US population. Now, for those of you familiar with buzzwords, omni-channel is more than a buzzword. Omni-channel refers to the combination of online, bricks and mortar, and other distribution channels for retail. And e-commerce is clearly complementary to bricks and mortar retail, as omni-channel customers tend to shop more frequently, 3 times more frequently, and spend more on average, 3.5 times greater spend than single-channel shoppers. In-store conversion rates are 4 times higher than online conversion rates. And I'm going to read you one quote. Some of you may be familiar with Bonobos, that was an e-commerce retailer moving into stores. They called them guide shops. On average, order values in the guide shop stores are double what they are online. Return rates are lower, and repeat transactions happen a short period of time. And while e-commerce accounts for 7% of all retail sales, that's growing. If you have an e-commerce sale only, because of the return costs and related to return costs, for every dollar of sales, the loss of returns results in a 77 cents net sale. You add on partial omni-channel, you buy online and you return it in store, you're going to buy something else. So all of a sudden that dollar, which became 77 cents, is now 95 cents because of 18 cents of additional purchases. In fact, if you buy it online and you pick it up and return it in store, now you're at $1.07. So omni-channel is real, and online retailers are realizing it. Not surprisingly, you're seeing a dramatic expansion of e-commerce online retailers in bricks and mortar. We don't believe there's one significant retailer anywhere in the world with online only that is making money. They're moving into bricks and mortar. Bonobos, I mentioned that. Bonobos currently has 30 guide shops. They're going to have 100 by 2020. Warby Parker, which is eyewear, started in 2011 online. They have 47 showrooms today in malls, and they're saying they're going to have 1,000 stores. Online only, going to be 1,000 stores. Amazon just opened a bookstore in Columbus Circle in New York. In fact, 24 hours ago, the real estate board in New York was in the press this morning. Was talking about this, and the real estate executive and real estate board referred to this as a shitty Barnes & Noble, quote unquote, pardon my French. Now, it's very clear, then, that online retailers are seeking a presence in the best malls. And if you can be within 56% of the entire U.S. population in 100 malls, that's a pretty good place to be. There's a big difference between an A mall and a B mall. An A mall is getting 63% higher sales per square foot than a B mall. They have higher occupancies, whereas B malls have negative average sales growth. A malls have positive, so the difference is almost 4% there. You get 67% higher rent in A mall versus a B mall, and your trade area and total income is 131% higher in A mall than a B mall. Now, I mentioned Brookfield owns 34% of GGP, so they talk about it a fair bit. We attended their investor day in New York a few weeks ago, and there's a great quote from Brian Kingston at the bottom of the page where he described one of their major apparel tenants that announced that their same-store sales were down 6% year over year. However, their same-store sales in their GGP malls were actually up 4.5%. Big difference. Not all retail is created equally. However, the stock market have punished all the same. Here's a chart that compares the stock price of GGP versus the stock price of 2 B malls, CBL and Washington Prime. In fact, GGP is recently gone below that. So this makes no sense whatsoever. There's a lot of people that are reading the Wall Street Journal every day and reading the demise of retail, and it's simply not true. And it's not true. Numbers do not lie. And if you look at the performance of GGP, and it's not recent, it's not new, it's consistent, year over year over year. Same-store growth up meaningfully, margin stable, sales per square foot growing, $600 on average, over $700 per square foot, sales per square foot based on NOI weighting. In fact, if you take out the apparel, it's over $900 a square foot. Occupancy is growing. Cash flow, the measure for real estate valuation, is growing and projected to grow again this year. In contrast to the headlines, GGP has continued to grow profitably. And why is this happening? How is this happening? And because retail's in transition. But this isn't new. This has been going on since the beginning of retail. I mean, you used to have record stores and Radio Shacks, and then you had Circuit Cities. Well, now you have Apple stores. You had the big darling tenant 25 years ago was Kmart and Zellers. Well, they're gone. And so retail has transitioned, and people are talking, well, you lost your anchors, your big box. The importance of an anchor is not that it's big. The importance of an anchor is that it generates traffic. That's the importance of an anchor. So the traffic generators today are different. They're your Apple store, your Cheesecake Factory, your theaters, and that's what's happening. You're seeing apparel go down, you're seeing entertainment uses go up, you're seeing theaters go up, you're seeing grocery stores come back to the mall. And the best centers continue to thrive. GGP itself, that transition is remarkable. They're going to move from 500 department stores to close to 200 department stores in 2 years. This is significant. So far, they've recaptured 115 of these boxes. 97 of them have been retenanted in them. 18 have been released to department stores. 0 are dark. 0 have no tenants. 0 are air and light. JCPenney, there's a picture there of the Natick Mall there in Massachusetts. JCPenney store, 194,000 square feet, 3 floors, leased to Wegmans, grocery stores. They will have 50 food stores. Some of you in Toronto may remember Yorkdale. There used to be a Dominion in Yorkdale. This is coming back to the mall. Why? Because that's where the traffic is, and that is a traffic generator. GGP has a waiting list of tenants looking for 50 of these boxes, and they're making money because these department stores paid very little rent. And so they're getting 7 to 10% unlevered returns on cost or 15 to 20% levered returns on costs. Look at Staten Island Mall, New York area. 1.2 million square foot mall, expanding 400,000 square feet. Sears is downsizing from 160,000 to 40,000 square feet. The top floor is going to Primark, which is a fast fashion brand from the UK. Think of Zara and H&M. And half of the first floor is going to Lidl. Some of you may recognize that. It is a large German grocer that's really conquering the United States in a discount grocery stores. Whereas entertainment was 0 in the mall currently, it will be 55% of the expansion. It'll be an AMC theater. Apparel, which was 72%, is going to be 15% in the expansion. It's going to be a Zara. And food and dining is going to be about 20% and will include a Shake Shack. Valuation, I said at the outset, this stock is cheap. And a recent leading analyst estimate of net asset value, the value of the bricks and mortar, $30.82 versus stock price around $21.50. That's a 30% discount to that analyst's estimate of the value of the real estate. Why do we need to buy bricks and mortar in the property market when you can buy it at a 30% discount in the stock market? That's an implied capitalization rate of 6.2%. Well, GGP sold a 37% interest in the Ala Moana Shopping Center in Honolulu for $1.37 billion, implying a $4 billion valuation for one of their 127 malls at a 3.9% cap rate. They sold a 50% stake in the Fashion Show Mall in Las Vegas at a 3.7% cap rate. Well, if you put a 4.5% cap rate, you get a stock price of $36, $36.50. Most recently, in the last few weeks, most recent comp, Forest City Enterprises, New York Stock Exchange listed company, sold a portfolio of 10 malls. Now, they were varying quality, but the average was 5% cap rate, and they generated, on average, $500 per square foot. GGP is generating 700 square foot, and the A mall that was in that portfolio, we understand, sold at a 4.5% cap rate. So as I said, we need some catalysts here because, a lot of people read Barron's and they read the Wall Street Journal and they read these headlines. And so there's 3 or 4 really powerful catalysts here, or one in particular. Firstly, the financial results. You're going to, people keep reading these newspaper articles and they're waiting for cash flow to fall and occupancy to fall. It's not happening. It's not going to happen. And when you have a setup such that folks that are reading all these dire warnings, you have generalists that don't own this stock. The real estate specialists and index huggers are underweight, and the hedge funds are short. That's a pretty good setup for a pretty fast recovery. You're going to start to get realization and awareness of what is happening with these boxes. This is good news, not bad news. Again, a great quote from the CEO of GGP. When you read headlines, Sears giving back stores, Macy closing 100 stores, JCPenney closing 120 stores, 140 stores, the instantaneous reaction of investors is, wow, this is trouble. The instantaneous reaction of headquarters in GGP is, wow, this is opportunity. They're transitioning, in fact, not just to other retail units. This is incredible land. This is well-located land in the best markets with high income. And they already have 15 hotels, 6 million square feet of office space, and 2,000 residential units in GGP properties. Asset sales. What have you done lately? The Forest City sale was buried in the portfolio, but you start to see asset sales validating these comps will be a catalyst. In fact, GGP is actively looking at partial interest transactions, which itself will be a catalyst. But the last catalyst is powerful. Brookfield Asset Management. They have a long history with GGP. They helped in the restructuring. As I mentioned, they own 34% of the shares, Brookfield Asset Management, through BPY, and they hold it at an appraised IFRS value on their books at $29. Forget what I'm saying. Read the lips of Brookfield Asset Management. Look at their public disclosure. And I quote from the Investor Day 2 weeks ago at the bottom of this slide. We think this is one of these classic Brookfield moments where others are fearful, and there are opportunities if you have a long-term focus and the right operating capability to take advantage of these situations. A classic Brookfield moment. And this is right on strategy. Since Bruce Flatt took over as CEO, they've been through a long transition from a property-owning holding company to a fee-based asset manager. They have a flagship public entity in every silo: infrastructure, energy. In real estate, it's Brookfield Property Partners. The blue indicates a public entity, the gray is private. There's one blue box that doesn't fit here. One of these entities, GGP, is not like the other. They very much would like to find a path to change this and to bring GGP into the fold as a fee-generating asset for, ultimately, Brookfield Asset Management. Again, not new, they've been doing it, right? Brookfield Office Properties, 5 years ago, became BPY. They privatized Brookfield Residential. After a couple of attempts, they privatized Canary Wharf. This is in process. This year was Brookfield's Canada office company, all public entities. Their Australian entity. There's one material one left, and perhaps the best of the lot, GGP. Just to wrap up, again, read Bruce Flatt's first quarter letter to shareholders, and I quote, "Today, there is a significant disconnect between private values and the public markets, and we intend to capitalize on this difference." And so it's cheap, and there's catalysts, and perhaps contrarian, but this real estate ain't going away. Thank you very much for your time.